Welcome to the Titans of Industry show on Wealth Research Group weekly interview with experts from finance, industry, commodities, and cryptocurrencies. This past week we had Jeff Berwick on from Mexico speaking to us. Braden Sadden, a self-made millionaire who explained the tactics he used in small cap investing, and Tukey Angus, the master negotiator from Kidneys Inc., and Trace Meyer, Bitcoin expert. Today, you're in for a treat as I'm hosting Gary Christensen. He's an author, he's a retired accountant, owner and writer at the deviantinvestor.com, and he has a new book out. It's called Buy Gold, Save Gold, and it's a wealth of information. His articles are published on deviantinvestor.com, as well as all these popular sites like 321 Gold and peakprosperity.com, Goldseed, Dollar Collapse, Brother John. So, Gary, first of all, how are you today?
Doing good, thank you.
Gary, I want to get going here, and as we're doing this, on the screen, we're seeing page 16 of your book, where it talks about the loss of purchasing power for the dollar. Now, walk us through this. When they started in 1913 with a gold-backed dollar, it was worth about 0.5 ounces of gold, and then looking at today, 104 years later, it's worth 0.001 ounces of gold. So this is like a 50-to-1 split, or basically a 98% loss in purchasing power. I have two questions for you regarding this information. First, what is the future of this trend? I mean, how low can this split go in purchasing power? And secondly, how have people been able to avoid living, people live 60, 70 years, so people live through half of this devaluation period. Obviously, they feel the effects of inflation. What I am asking you is, do you think that all assets, basically worldwide, are inflated because people are afraid of saving fiat currencies in the bank? So basically, they buy real estate, they buy stocks, they buy art, they buy cars, everything we buy. Do you think if the monetary system was more sound and backed by either gold, silver, or something tangible that has intrinsic value, do you think everything will deflate down and everything would be more affordable for the common man?
Well, okay, that's several questions there, and I'll try to go after those. First of all, let's start with gold. In 1913, gold was $20.67 an ounce in the United States. And that meant that you could buy a $20 gold piece, which had slightly less than an ounce of gold in it. That $20 double eagle was the standard. It circulated just like dollar bills circulate today. People used it to buy, a week's worth of groceries or 2 weeks worth of groceries or whatever. And at that point, it was $20.67 an ounce. Gold today is just short of $300 or $1,300 an ounce, about $1,275. If you put that going backwards, and that's why I don't like to look at it in terms of the price of gold per dollar. It's how much has the dollar devalued against the price of gold. And so that's why I said 0.05 ounces of gold. So 1/20th of an ounce of gold, meaning $20.67 for an ounce of gold. That means a 20th of a dollar bought a 20th of an ounce. Now, a dollar buys less than 1,000th of an ounce because the price of gold is now $12.75 roughly. So the point I'm trying to make is gold exists. An ounce of gold is an ounce of gold, whether it's in 1913 or 2017. But dollars that used to have a whole lot of value now have very little value. And that's true around the world. It's true whether it's euros, it's true whether it's rubles or yuans or Zimbabwe, whatever. Currencies devalue because they aren't backed by anything substantial. During the 19th century, from say 1800 to 1913, the prices of most everything, consumer goods, were relatively speaking stable because it was a gold standard at that point and things were backed by gold. In 1913, we created the Federal Reserve in the wisdom of the Congress and the president, and gave the control over to bankers. And the first thing the bankers wanted to do was put everybody onto their system. Of course, what would you expect? And that involved devaluing the currency, putting everybody in terms of debt, and we've gradually moved from gold circulating to gold certificates circulating to silver certificates circulating to nothing but pieces of paper called Federal Reserve notes, which are actually nothing but debt circulating. We have devalued the currency, and that's why when we quote the price of gold in dollars, it's gone so far up. Now, later in the book, and I realize I'm long-winded here, but I'm going to stop this in a moment. Later in the book, I point out that the same is true whether you're looking at the price of silver, the price of crude oil, the price of the Dow Jones Industrial Average, the price of the S&P 500, or most everything else. The prices have gone up because the purchasing power of the dollar has gone down. So to get back to your point about what's the future of this, well, expect more. We've got a century of more or less continual devaluation of the dollar. We've got a century of exponential increases in the price of the Dow Jones Industrial Average, exponential increases in crude oil, exponential increases in gold, because the value of the dollar is decreasing, and decreasing. What would we expect for 5 years from now, 10 years from now, 20 years from now? Much less. Debt in the world is going to go up. The value of the dollar is going to go down. Prices for everything are going to go up. Now, that doesn't mean that gold will be up 20%, the Dow will be up 20%. Gold might be up 1,000%, and the Dow might be up 100%. It'll vary depending on the type of asset it is and whether it's backed by something real like gold or whether it's paper. But you can expect, in fact, you can almost literally guarantee that we are going to devalue the currency, and that isn't just the dollars, that's euros, yen, you name it, and we're going to devalue the currency and increase the prices of almost everything. So I'll give it back to you now.
Gary, what I like about the comparison with gold is that gold relatively, it doesn't change. If anything, to mine it 100 years ago would be a little more complex than using our current methods and our current system. So you would actually expect the price of gold to be less today than 100 years ago, when it was harder to find it. You had no gravity maps, you had no geological modernizations methods. So the fact that it went 50-1 with the price of gold is absolutely shocking. Like, if you take real estate, obviously the modern home is much more valuable than a home 100 years ago, where you had no electricity, the materials were far less strong, etc. The neighborhood was a lot less nice looking. So you can think that real estate is more valuable, but an ounce of gold is the same lump of metal as it was 100 years ago. So this makes it the strongest point that the dollar is simply losing value more and more. Now I want to move on, and on the screen is featured the annual average of gold prices since 1913. Can you take us on a journey of 104 years from 1913 till present day? Explain to us exactly what we're looking at. I can see the compound rate going up at about 6.3% per year. And can you explain all of these stops and trends in the road?
Okay, starting back in 1913, when the Federal Reserve was created, I stated the price of gold was $20.67. And that's because it was circulating and it was mandated by law at that price. This is the critical point. That wasn't a market price. That was a U.S. government price because they put out a $20 double eagle, which had just slightly less than an ounce in it. So therefore, by definition, the price of gold was that price, $20.67. And that was good until 1933, when President Roosevelt realized he needed to create some inflation in the U.S. economy. He called in all the gold and made it illegal for, and with some reservations, illegal for people to own, for private individuals to own gold in the United States. Consequently, much of that gold was shipped overseas into Europe or taken in by the U.S. government and melted down into gold bars and stuck in Fort Knox and various other places. So from 1913 to 1933, $20.67. From 1933 to roughly 1970, the price of gold again was mandated at $35, a price that President Roosevelt set. So those two periods of time, from 13 to roughly 1970, the price of gold looks very flat because it wasn't a market price. And that's what I've got at the very bottom of that book. I've got government prices. Those were prices established by the government. Once Nixon... Go ahead.
Can I ask you about these two periods? How do they figure the mandated price? Why did they choose 20 and then 35? I mean, what prompted this calculation on their part?
Well, I think you're going at it backwards. Think of a coin that is mandated, that is a gold coin that's circulating, and it is established that this coin has a face value of $20. 20 US dollars is the established value. And if it's got 0.96 roughly ounces of gold in it, then it becomes $20.67 as the price of gold. They were circulating gold coins since, I don't know, the mid 1800s or early 1800s. Gold coins circulated as money. They were money, and they had a face value on them. Now, it's the government was buying gold at that price and minting it and putting it out into circulation. It didn't fluctuate day to day. Nobody looked in the newspaper to say, what's the price of gold today? Because they didn't need to. They knew the price of gold. The price of gold was a $20 gold piece in their hand. And they might be worried about the price of oats or the price of hogs, but the price of gold was standard, and you used that gold to buy hogs or wheat or bread or whatever. Today, we use dollars, which are Federal Reserve notes, which are debt, and that debt buys more or less houses, more or less wheat, more or less gold, more or less silver, depending on market conditions, international conditions, and so forth. It's hard for people to realize the difference because back in 1913, things were constant in terms of the unit of measure. It's like you've got a foot-long ruler, it stayed a foot long. It stayed a foot long no matter what. Today, the foot-long ruler, meaning the value of the dollar, is 18 inches one day, 16 inches another day, 3 feet another day. You know, it varies because the purchasing power of that unit of currency keeps changing. That's one of the reasons why it's difficult to do business today. And it's also one of the things that keeps the profitability of Wall Street very strong. It's because they keep working with the price of the dollar, of the currency. Back in 1913, not the case.
Interesting. So yeah, pick up the story where you started talking about the late 60s when they wanted to audit the Fed, and then I stopped you there.
Okay, well, and what happened was that the United States, as we all know, went into a disastrous Vietnam War, and we spent, $1 zillion. And part of President Johnson's deal with the people who wanted war was also that we're going to get social programs. So we created all these social programs, which were expensive, expanded Social Security, Medicare, and various other things. And so we were spending a great deal of money that we didn't have, we meaning the United States government. So the government had to go into debt more and more each year in the 60s to fund the war and the social programs. Well, all of the dollars that they spent overseas on the Vietnam War and their various other military activities were sitting in various foreign governments and foreign central banks as dollars. And some of them, most notably the French, but many of them actually said, well, we don't want the dollars. We realize the United States is spending and spending like there's no tomorrow. We want gold. According to the Bretton Woods Treaty, which was back in 1944, the dollars were exchangeable by foreign nations for gold at $35 an ounce. That was the mandated price. And so that price was there. Foreign banks or foreign central banks distributed dollars and sent them to the United States, and the United States sent gold in return. Well, President Nixon realized that this couldn't continue because we had way too many dollars outstanding, and we weren't going to cut back on expenses. So pretty soon the United States would be out of gold. We would have spent all of our gold and distributed it to foreign nations in accordance with that treaty. So the first thing it did was they had the Washington Agreement, where they tried to, or the gold stabilization policy there, where they tried to hold the price at 35, and then they went to 38, and then I think they went to $42, but they couldn't hold it at those prices. So August 15th, 1971, President Nixon abrogated that treaty and said, we will no longer exchange dollars for gold. The critical point is we no longer will establish a price for those dollars when measured in gold. So that meant that dollars could devalue very rapidly because there were way too many of them. You print too many dollars, you get more of them, you get the same quantity of goods, so therefore the value of the dollar goes down. Hence, the value of the gold goes up, hence the value of silver goes up, the value of wheat goes up, the value of the Dow Jones goes up, etc., etc. That's why when you look at that graph, you see gold playing catch up, meaning it should have been much higher by 1971 than $35 or $40 an ounce. It should have been much higher than that because there were so many dollars created throughout the world. So gold played catch up. And then once it started going up, then a lot of people jumped on the bandwagon. They wanted gold. Panic set in. There was massive inflation in the United States. The United States exported inflation elsewhere. And the price of gold ultimately, and this is in January of 1980, reached just over $850 an ounce for a very short period of time. So the price of gold went from around 40 to over 850 in about 9 years, which is a pretty shocking rise. Clearly a bubble, and it wasn't going to last. But it was a big ride while it happened. That's why the price of gold spiked up so much. Now, the average price in 1979 and 1980, meaning you take the daily price and average it over the whole year, was only around $600 and some dollars. It peaked at over $800. And then for about 20 years, gold languished. It actually went down to around $255 in 1999, and again to about $255 in 2001. And those were the lows for the price of gold. So it spent roughly 20 years correcting in price, which means the dollar was valuable in that period of time. The dollar was depreciating less rapidly. Not that it wasn't depreciating, it was, because during that same time, price of the various stocks and bonds were rapidly rising. So the excess inflationary dollars went from the gold market and the crude oil market into the stock market and the bond market. Well, 2001, we had 9/11, and we started spending money like there was no tomorrow again, lots of debt, and furthermore, the central banks were cutting back on the amount of gold they were selling into the markets. Price of gold and silver bottomed in 2001 and started rising, and they rose for another decade and peaked in 2011. And that again shows in the graph here. And remember, the graph is a logarithmic scale, so if you look on the left-hand side of it, you can see that the prices double, every unit. All that shows is that the price of gold was increasing exponentially, and the approximate exponential rate increase is described by that dashed line I've got there, and I've rated that at about 6.3% per year. Of course, the price of gold streaked much higher and much lower than that average line, but that was the point. Over over 70 some years, the price of gold increased every year on average with very large deviations. Not because gold was bigger or better or more valuable, but because the dollar that was used to buy it was decreasingly had decreasing value. It kept depreciating and depreciating and depreciating because we printed so many more of them that their average value went down. It's really quite simple in the big picture. Print lots more dollars, you're going to have, each one's going to buy less. End of story.
Now, Gary, I don't know if you're privy to this information, but do you know how much of the currency supply of U.S. dollars is currently backed by gold?
Well, zero. There's nothing in the United States that's backed by gold. There is.
What I mean is, if you would take gold ounces in existence and divide them by the amount of dollars, what would be the price of gold? Meaning, if you had to reinstitute the 100% backing of gold to the currency.
I don't know exactly, but I think that you'd be looking at, and of course, I have to qualify this. When we say the total dollars are existing, do we mean M0, M1, M2, M3? I mean, it's a question of the definition of how many dollars are in existence. That's the first question you have to establish. And then the second question you have to establish is, do you want to back by 100% or 40% or 20% or 0%? But given those kinds of things, in round numbers, that's all of this is round numbers. We'd be at gold price of $50,000 to $100,000 per ounce if you wanted 100% backing, depending on, again, the criteria by which you measure the total number of dollars in existence. Jim Rickards has talked about this extensively in his books, and he suggests that 100% backing wouldn't be necessary. 40% would do nicely, even 20% possibly. Of course, you have to realize that politicians are politicians and central bankers are central bankers, and they'll do what they're going to do, and that means they're going to spend too much and devalue the dollar along the road. But regardless, with those kinds of numbers that Jim Rickards is talking about, you'd be looking at $10,000 or more for the ounce of gold, based on the massive increase in the quantity of dollars in the world today.
Now, one of the most interesting parts of your book is about the vital shift in precious metals from west to east. And we're looking at page 32 now on screen. What do you mean by that bullion has moved from west to east, and what are the impacts of this on the global economy? Let's say a few years ahead, 5-10 years ahead into the future. How will this affect the way that the politics works and just the general economy?
Okay, well, interesting questions, not clear answers. So let me provide, and let me make this clear up front. These are just my opinions, and they're certainly not shared by Wall Street. But if you look at the movement of gold from west to east, first of all, it's opaque. It is not transparent. Central bankers do not publish the information. It is China. The gold is moving into China, Russia, and India, as well as other places, but those are the three big ones. Russia publishes their information every month or every 2 months as to how much they have in stock, and they're adding many thousands of ounces every month into their stockpile. China publishes their information every 6 years or so, and I have absolutely no reason to believe their numbers. India doesn't have numbers that I'm aware of. So the amount of gold that's moving is very difficult to measure if you look at that, or if you look at the source, the Western central banks. But Switzerland publishes information, and I've seen these numbers, where the refiners state we're working 24 hours a day. We're taking 400-ounce good delivery gold bars, which are the type of things that the United States and London and Western countries use, 400-ounce gold bars of 99.5% gold. And they are taking those in quantity and refining them down in Switzerland to 1 kilo bars at 0.9999% gold. So they want 4 nines gold, that's 99.99% pure gold, in 1 kilo bar size, and shipping those to Asia because that's the desired format that Asia likes their gold. And according to the stuff I read, Switzerland is doing this extensively and 24 hours a day, cranking up the process where they're just shipping a massive amount of gold from west to east. Again, it's not transparent. It's not crystal clear, but it is happening, and it's not too hard to figure out that China is importing gold that's mined throughout the world. China does not export any gold that's mined within China. Russia does not export any gold that's mined within Russia. So they're keeping all their own gold, plus they're buying gold from the rest of the world, plus they're buying gold unobtrusively and under the table from anybody they can get it, again without clear numbers, and so on. I cannot point to these things, but I'd like to I'd like to quote Alistair MacLeod, who writes for Gold Money, and this is an extremely smart, well-educated man. He says, China places, and this, by the way, is an article, he says, America's Financial War Strategy dated April 20th. And so this is a recent article that Alistair MacLeod has put out. And several pages into the article, he says, quote, China places a great emphasis on hoarding gold, both for itself and its citizens. The public has acquired an estimated 12,000 to 14,000 tons since 2002. And this writer, meaning Alistair MacLeod, has speculated that the government has hoarded in various accounts as much as a further 20,000 tons since 1983. Well, I can't verify his numbers, but I'm not going to argue with him. He's certainly done the research. Again, they're not transparent. He can't prove those numbers, but he can make very reasonable guesses. For perspective, 20,000 tons of gold is a huge amount of gold. The total amount of gold that's been mined throughout history is some number like 170 or 180,000 tons. So that's saying that China has a significant percentage of all the gold that's ever been mined in history. And for perspective, the U.S. official gold hoard, which is very problematic that it even exists, but officially it exists at around 8,300 tons. So if Alistair MacLeod is correct, and China has 20,000 tons and the United States has 8,300, that indicates that the gold has moved from west to east, and that they will have a much larger impact in economic issues as well as in the IMF and the composition of the SDR, the drawing rights that the IMF puts out. So the implication for this is who has the gold makes the rules, and I think that just simply says that China is going to have a larger and more important role in the world in the upcoming years and decades because they'll be a more powerful economic entity. They will be able to back their currency either unofficially or officially by gold because they have it, and the United States will be less able and Europe will be less able to do so because they increasingly don't have the gold.
Those gold shipments have got to be the most beautiful pieces of shipments of anything. Just to take a beautiful bar from Switzerland and move it to China, those got to be beautiful, beautiful gold bars. Gary, I want to. I'm looking at on the screen. We're looking at the U.S. official national debt per capita. Now, $60,000. To whom does the individual owe $60,000? And who is bankrolling and funding 325 million people's average $60,000 debt? This is it's almost ridiculous.
Well, okay, let's back up a little bit. Let's start with the U.S. official debt. Now, this is official debt, not the unfunded liabilities, but just the on-the-books official debt is approaching $20 trillion, about $20,000 billion. And for perspective, the U.S. national debt was about $3 billion in 1913. So we've gone from roughly 3 to roughly 20,000 billion in the space of 104 years. So where did that money come from? Well, if you look at that $20 trillion, most of it is debt that's owed to pension funds, insurance companies, individuals, other companies, hedge funds, whatever, they have bought this debt as T-bonds. The Treasury issues a T-bond, and the Federal Reserve funds it, and then they sell it. These things are out there. They are collecting a minimal amount of interest, and they're used by, like I say, insurance companies, hedge funds, individuals, retirement plans. There's trillions of dollars in retirement plans in the United States. Plus, there's some percentage of that $20 trillion is also owned by China, by Japan, by Russia, by Europe, or various other places. And I don't know what that number is. It's several $trillion. And then there's also several trillion in that national debt that is the, quote, lockbox, quote, for U.S. Social Security. And what this amounts to is U.S. individuals who are being paid by payroll checks contribute a certain amount of money out of their check for Social Security and Medicare, and then the employer matches it. The Social Security portion of those funds, that's 6.2% of their gross pay, goes into the Social Security Fund, which the U.S. government promptly spends and then issues an IOU, which is part of that $20 trillion. So part of that $20 trillion is IOUs issued to the Social Security Administration. The money's been spent for various other things. So that's why people call the Social Security Administration a Ponzi scheme, because it's taking current money and paying out benefits for previous people who put into the fund. So the $20 trillion is composed of Social Security funds that are owed, foreign debt, people that have bought our debt for various goods and such that have come through, like the trade deficit. That would be Russia, China, Japan, and others. And then money that has been loaned to the U.S. government by pension funds and other domestic people, domestic entities. So if you take that 20 trillion, divide by 300 and some million people, you get 60-some thousand dollars of debt per person. Now, realistically, that individual doesn't owe doesn't owe $60,000, but his share as a citizens of the United States that is in some sense responsible for the government could be related to $60,000 as his share of debt. And the point I'm making is a family of four then owes $250,000. And the reason I say that is because I want to put it in a perspective that the average person can understand. And the average person is going to say, oh my God, my family owes as a share of the national debt $250,000. I haven't got it. So where is it going to come from? And the answer is we're going to create it out of thin air, like we've created most of it out of thin air, and we're going to deficit spend and then have the Treasury Department issue bonds, and then the central bank is going to buy those bonds. So we're going to just keep on cranking it, and that is the process by which the dollar is devalued. And that's why you can guarantee that the dollar is going to continue to be devalued, because you won't find anybody in Congress or the administration or the Federal Reserve that says, well, let's reduce the debt down to zero. It's not going to happen. So we're going to keep spending, keep increasing the debt, and the average person is going to have an increasingly large share, which of course they won't pay. And so then the value of the dollar decreases because we're just going to keep devaluing the dollar. That's the process.
It's alarming and very interesting. So basically, you either have a politician coming in and say, hey, let's collect 60 grand from every individual, and per capita, as you explain it, means everyone, children, retirees, people in hospitals, etc. This is per capita, correct?
Correct, and that's not going to happen. So it's only put in there as an example to show. But the important point about national debt is that if you look at national debt and you just look at it since 1913, it's been compounding at over 9% per year. So we're increasing national debt at over 9% per year. And then if you want to do it on a per capita basis, meaning clearly if we have more people, it's understandable that we have more debt. But the fact is national debt has been going up in a per capita basis at about 8% per year. So that just means that we're spending and spending and spending way beyond the increase in population. So we just spend and spend and spend. And, you have to ask yourself a simple question. What politician doesn't want to spend somebody else's money? And the answer is it doesn't exist. Everybody wants to spend somebody else's money, so we're going to keep spending and spending and spending. We're going to keep devaluing the dollar. I don't mean to harp on it, but that's the fact of life for 104 degrees. And consequently, the price of most things, specifically gold, is going to go much higher.
Now, the next chart we're looking at is very interesting because when I started researching the gold-backed currency system, going back to many civilizations and empires, etc., what was always intriguing to me is if people create more and more wealth all the time and the gold is not mined at the same pace as people are building wealth, then you've got a restricted economy. And so what you create is on page 48 is the connection between population growth, national debt, and ounces of gold, meaning that you would think logically that the more population there is, the debt load would subside. And we're looking at a cyclist, we're looking at a boom bust type chart. So basically, we're looking at a politics system that does not care the debt load of the average person. They have their own agendas politically, and they're not even considering that they work for the people. They're just using their own agendas and creating debt loads that are larger and smaller, etc. People feel wealth effect, and then they feel restrained, etc. Has nothing to do with the average person's wishes. Is this the conclusion of this chart?
Yes, I will. Let me describe it in my words, and I'm not disagreeing with you at all. I'm just going to put it into a different context in different words. The point of the book is to say debt is increasing outrageously and impossibly fast, 9% per year, essentially forever. And the overall economy, meaning the gross domestic product, any way you want to measure it, isn't increasing as rapidly. So the consequence is we have to increase debt. We keep spending, and the economy isn't generating enough revenue to justify government spending. And so we increase the debt. When you increase the debt, you can say, well, it's because of increased population. And I say, no, it's not. If you take the debt per capita, clearly it's increasing rapidly. And then you say, well, it's because the dollars are devaluing. Well, that's true. The dollars are clearly devaluing because the price of gold and everything else is going up because we're measuring it in tinier and tiny dollars. But if you look at this chart, what it's telling you is that even after you adjust the national debt by the population and then further adjust it by the smoothed price of gold, and I've smoothed it with a 10-year moving average just because the price of gold jumps so erratically. Even after you adjust it by the price of gold, the debt is still increasing exponentially, and it's like the ratio was about 2 back in 1917, and it's around 50, 60 now, so it keeps increasing. What that means is the debt is increasing far more rapidly than population, far more rapidly than the actual price of gold. The debt just keeps increasing and increasing, and the implication to me is that someday gold is going to catch up with that massive increase. And the only way it can catch up is if the price of gold substantially corrects higher.
Okay. Now, the next chart is the much talked about connection between the S&P 500 and gold. Basically, you can see that it has very long cycles, and my question to you, first of all, is: do you even think that this chart matters? Do you think people say, okay, the S&P 500 is cheap compared to gold or expensive compared to gold? I'll make a decision based off of this chart, because to me, not many people own gold, less than 1% of the population. And so this is a good measure technically of when is a good time to either become bullish on stocks or become bearish on stocks. But what is the value of this to the investor? Because right now it looks like it's trending on that resistance line and is poised to go higher, meaning that you believe that gold will outperform the S&P 500. Now, just to be clear, the S&P 500 has underperformed its own historical average for the past 20 years, returning about 3 to 4% per year instead of the 7 to 8% per year, including dividends, historically. So, are we going into a phase here, a time where either the S&P corrects real hard to make this ratio bounce back from resistance, or the price of gold goes up a lot? Which is it, or is it both? What's going on? Obviously, we've been on the second largest the second largest bull market in stocks in history, going on almost 8 years now, more than 8 years, 8 years in about 1 month. So, what is this ratio indicating to us right now, Gary?
Okay, and good questions. For the people listening, that's the graph that on the book is on page 75. On your PDF version, it's on page 76, right? Yeah. Okay. And so this is the average annual ratio of gold to the S&P over 30 years on a linear scale. And the first point that I need to make with this is, of course, gold and the S&P are cyclical. I mean, stocks go up, stocks goes down, gold go up, gold goes down. But in the long term, and this is the critical point, in the long term, because we're measuring them in devalued dollars, they're both going up. Now, realistically, when the S&P is strong, gold is typically weak, and when the gold is strong, the S&P is typically weak, and so they are going to go. The cycles are going to be more accentuated. But what this chart shows is that from roughly 1991 until now, the trend has been that both are going up. And part of the time, the S&P is going up faster than gold, and part of the time, the gold is going up faster than the S&P. Currently, meaning here in 2017, we're at the low end of that ratio, and that tells me that we're very likely to see much higher gold prices. And because we know that we're going to devalue the dollar, the S&P is likely to go up or correct somewhat in the long term. But we'll see much higher gold prices, and so that ratio will increase. Now, if we go back to the point of the book, which was the 10K logic, I'm saying gold should reach $10,000 probably sometime in the next decade. I'm expecting the S&P, which is at all-time highs right now, to correct, and I'm not going to specify how much, but a lot of people have talked about 10%, 30%, 50% correction, and then I fully expect it to go back up again because we're going to crank the money supply, crank the debt, and produce lots more dollars to buy the S&P, and so it will, over a course of years, go up again. In the meantime, gold will go up a whole lot while S&P is going up some. So this chart should tell you that on a long-term cyclic basis, now would be a good time to be moving into gold and out of the S&P.
Now, the next one is the gold to silver ratio going back since 1975. And what's very clear about this is that it has this clear resistance and support lines, and it bounced off of the support line. What is it, like 2015, Gary? Last time?
Yeah, on the ratio, that's the resistance line up at the top. Yes, and so yes.
And okay, so it bounced out of the resistance line last time in about 2015 at about 80 to 1 or something like that. And so we're looking at a move here that will take it all the way down to about 40 to 1. Looks like technically, or at least let's say halfway there, etc. Is this a time now where both are going to go up, but silver higher, Obviously, that's the listening to your other answers, this would be what you're implying. And secondly, all three times, the last three times that this ratio hit about 80, which are clear in 2003 and in 2007, and now again 2015 or something, or 2016, whenever that last happened, the gold stocks and silver stocks outperformed the actual metals. So basically, when silver outperformed gold, the juniors are starting to pick up pace. Has that been your experience?
Yes, the reason why the gold to silver ratio is important is because what it shows is the degree of frothiness or depression in those markets. And by that I mean when the prices of gold and silver are going up, and over the long term, by the way, they're correlated extremely tightly, 95%, 97%, depends on your measurements and your time schedule, but they're correlated very tightly. So just assume that if they're not going up together, it's only for a short period of time. In the long term, they will go up and they will go down together. And if they're going up, silver is going to go up more rapidly than gold on average, and more rapidly than silver will be the gold and silver stocks. So the leverage will be with the gold and silver stocks, then with silver, and then with gold. And I love to quote Jim Sinclair on this because, the people probably know Jim Sinclair. He's Mr. Gold. He's been watching the gold market and managing things, and he's a brilliant individual. And he's been, he was one of the largest traders in 1980 at the gold peak when he got out at the peak. And he says silver will be gold on steroids in the next rise. And that's what this chart shows, is that every time the ratio is high, that means when the gold to silver ratio is high, like 80 to 1, 90 to 1, it even peaked at about 100 to 1 back in 1991. That means the prices for both, not just silver, but the prices for both are too low. When the prices are low, then they turn around and the price of silver will accelerate higher more rapidly than gold. And since silver is the denominator in that ratio, that means the ratio is going to go down. And it'll go down to some number like 40 or 50, and potentially even down to 20 or 15 in a massive bubble like in 1980. In 1980, I think the ratio dropped to as low as 15 to 1. So I'm not saying what the ratio will go to, but I'm saying that if we have the big move up in gold that I expect in the next 5 to 7 years, then we should expect an even larger move up in the price of silver, and we should expect that ratio to drop to some number like 40 to 1, 50 to 1, 30 to 1, 20 to 1 possibly, depending on the degree of craziness in the market. If it really goes crazy, it could be even down to 15 or 10 to 1 because the price of silver will go absolutely crazy when the price of gold goes up. And I think the price of gold is going to go up substantially because we're going to devalue the dollar, devalue all other currencies massively. And that's then when gold goes up some, silver is going to go up a lot. And those stocks that are underlying those are leveraged even further, and they're going to go up huge. And for the sake of readers and listeners who are on this, don't forget, things that go up rapidly come down rapidly. So we might see crashes also that are massive. For instance, after 2011, the price of silver went down something like 70%, whereas the price of gold went down 40-some%. So if it goes up fast, it's going to come down fast. So, but that's what this chart is saying, is that both right now are relatively inexpensive, and we should expect both gold and silver, most particularly silver, to rise higher.
That's interesting. My question would be, obviously the price of gold will go up because of its monetary role, not as role as jewelry or anything connected to its industrial electrical component, etc. So you feel like the value of the price of gold will go up because of the valuation of the dollar. Now, silver is not monetized for many decades, meaning not even the central banks do not buy it or sell it, governments do not buy it or sell it. If for it to go up substantially and act as its role as money, that would mean a frenzy in silver. So do you believe that either, or do you reckon that any government in the East or the West will start accumulating silver again? Or what would be the caveat for silver to make such a unprecedented move? Because the market now feels like silver is a very, very good precious metals for industrial reasons.
Well, okay, I doubt, and this is just an opinion, I doubt that any government or central bank is going to start monetizing silver. Silver is an industrial commodity, and in fact, most of silver is mined as a byproduct of zinc and copper mining. It isn't mined even by itself. So, silver is used in many, many industrial applications. And of course, one of the big, heavily hyped ones is solar energy. And we're using much more silver and solar energy every year. And solar energy is going to become more and more important in the next few years. And that's just one of many, many uses. It's also used in medicine. It's a bactericide. It's going to be used for sanitation purposes. And the number of uses for silver industrially are just almost unlimited. It's also, and this is going to be the driving force, and this is the real answer to your question, the driving force, as I would see it and as many other people would see it, for silver will be investor applications. The individual investor is going to be investing in silver. And this is going to be for several reasons. First of all, silver is universal throughout the world as money. Gold is the money of kings and central bankers, but silver is the money of the common man. They understand silver. The word in many languages for money is silver, and vice versa. They're related. People will look at the price of gold and say, $5,000 an ounce, $3,000 an ounce? I can't afford that. What's the price of silver? Okay, let me buy 10 ounces of silver or something, because I can't afford to buy gold. Gold is going to price itself out of the reach of most people, but silver is going to be available. And right now, silver is under $18. You can buy a Silver Eagle, which is 1 full ounce of U.S. silver, for $21 or something. It's a bargain. Those things are going to sell for much, much more. And that's going to be the attitude among many millions of people as they realize, oh my God, my money is worth less and less and less. They're spending like there's no tomorrow. They are devaluing the dollar and the euro and the yen. I don't mean to poke on the dollar. They're devaluing all our fiat currencies so rapidly. I've got to put my money into something that's going to keep its value. I don't trust stocks. They're going to create another crash. Look, we crashed them in 98. We crashed them in 2000. We crashed them in 2008. Probably going to crash them in 2017 or 18. Don't trust those things. What do I trust? I trust silver in my hand. So there will be a frenzy at some point. I'm not saying when, but you can expect a frenzy for both gold and silver. And there's no rush like a gold rush, and the silver rush is going to be even more spectacular and probably even more crazy because it's available and within the reach of the common man. So that's another reason why silver will go up. Plus, it's industrially needed. There's always going to be a demand for it. So you can expect the demand to increase, and the mining supply of silver seems to be increasing very slowly or flat. So where else can you go but higher prices?
Sure. Lastly, we're looking at the XAU to gold ratio. This is a very very important chart to many of our listeners who are not only investing in gold and silver as insurance and money outside the system, but they're also looking to make a small fortune with either the major or the junior stocks. Now, before the interview, I spoke to you about the fact that for a junior mining bull market, a really aggressive one that takes on for 2 or 3 years, not or even 4 years, not like the 6-month period that we've seen in 2016. What usually prompts it is the major companies the large companies, the companies that are the components of the XAU index, which are now on screen, when they start to issue larger and larger dividends, institutional investors, funds, enter positions and they start banking on these dividends. Then they start applying activist pressure on these companies and say, look, we're taking a look at your books, we're seeing more and more assets depleting, start buying juniors. And that's when the valuations of juniors start to go up for 3-4 years straight. This chart, which I'm looking at, is incredible of the XAU to gold, because it shows that gold as the denominator has outperformed the XAU for more than a decade. This is a very long time. In fact, if you disregard that sideways period, it looks like gold has outperformed XAU since the late 90s. And then you see that arrow pointing up, which means that you're looking for a reversal at some point. It looks like even it's trying to peek out of that bottom right now. Obviously, that would be 2016, where the XAU did outperform gold. What do you see as the catalyst would be my first question. And if you had to take that chart much further back in history, is there any time in history where you've seen a 20-year period where gold outperforms the stocks aggressively?
Okay. Interesting questions. I'm going to have only partial answers to those. First of all, let me go back to that chart. It's the XAU versus the gold ratio, and it goes back to 1984. It's a linear chart, and what it shows is that the ratio was around 0.25 from 1984 to roughly 2005. So for roughly 20 years, that ratio just flopped around. It went up higher, it went down lower, but it stayed relatively flat during that period of time. And then somewhere in the 2005-2006 range, it just fell off a cliff and dropped from, say, 0.25 to under 0.05. So it dropped massively. The XAU just came down hard. And I don't really have an explanation for that. I've heard lots of people saying that the gold mining companies were targeted, that they were not supported, that they couldn't get capital, that they were going out of business and various other things. I can't speak to that knowledgeably. I can just tell you that the XAU stocks were killed. They went down hard into roughly the end of 2015, the beginning of 2016. And they went down much more rapidly than the price of gold. And the price of gold, as we know, bottomed in 2001, peaked in 2011, and then has been down more or less since into 2015, December 2015. But as the price of gold went down a little, the XAU went down a lot, and consequently that ratio went way down, and way down to the point of like 20% of what it had been 10 years ago, which tells me that the ratio is a good indicator of long-term trend changes in the gold market and the stock market and the XAU stocks, the gold stocks. And what I see by that ratio is that it bottomed in 2016 early and then rose up from there. The XAU had a substantial move and gold had a small move in that period of time. And it has a very long way to go. That ratio has a very long way to go, which means to me that while I expect gold to go up substantially from here, I expect the XAU to go up many times larger than that, as indicated by that ratio. In fact, the ratio would have to rise by a factor of 5, which would mean even if gold stayed the same, the XAU would go up by a factor of 5 just to be back to the levels that it was from 1984 to 2005. That's how beaten down that whole sector of gold stocks is. And by the way, the XAU isn't entirely gold stocks. It also has some silver stocks in it. It's just a basket of, it's just an index, a basket of gold and silver stocks. But it's been beaten down very, very hard. This was back to the point I was making. As gold goes up a little, silver goes up a lot, and the stocks that underlie them go up huge. And similarly, when they go down, gold goes down a little bit, silver goes down a lot, and the stocks goes down huge. Well, the stocks have gone down huge, and as of roughly a year ago, they started going up. And it's my opinion, and based on my understanding of what we're going to do with the devaluation of the dollar, the increasing price of gold, and the ratio of these stocks, we should see the stocks go up substantially from here, many times more than the price of gold going up.
Understood. Obviously, XAU going up means that the GXJ and the GXJ, the juniors would go up even more.
Probably, yes. The GDX and the GDXJ will probably go up even more. They're very volatile, and they're very leveraged, which is to say, be careful, because they're going to go up huge and they're going to go down huge. So you want to be careful with what you're doing. But yes, they're a very good leveraged play on the gold and silver markets. And that is to say, if you want a conservative investment, you're buying gold. If you want a slightly more aggressive investment, you're buying gold and silver and favoring silver. And if you really want to speculate, you're adding the gold and silver stocks in there. And at this point, it seems to me like all of those are good investments and good choices.
Gary, where can people find the actual book?
Well, the book is available on Amazon, and the book, again, is Buy Gold, Save Gold, the $10,000 logic. I call it the 10K logic, and I'm just saying this is the logic for a $10,000 price level on gold. Again, we're going to devalue the dollar. It's going there. Whether it goes there in 2019 or 2023 or 2027, I'm not sure, although I have talked about it in my book as to when I think it's likely, but we're going to see much higher gold prices. So it's available on Amazon, of course, both as a paperback for $7.99 and as a Kindle, I think, for $4.99. It's available on my site at gechristensen.com. And for international viewers who don't have access to it on Amazon, I can sell a PDF version of it, which is what I sent to you. I can sell a PDF version of that on gechristensen.com. I encourage people to read it, not because I'm trying to make a fortune on gold, but because I'm trying to get the message out. People should realize their pensions and their savings are volatile and dangerous in spite of what you hear from the powers that be, and gold is a good way to hedge. It's a good insurance against the declining value of all of our fiat currencies.
Sure, and as a chart guy, I gotta say, that was an easy read for me. I took maybe 3-4 hours to go through 166 pages, and look, for anyone who is serious about the history of money, and just the mechanism of everything, and to get it more simplified, great book. Just an ideal book. It's very easy to read. The text is filled with charts, which is what I like. And look, I had a very good time, and I had a very good time interviewing you, and there are several other charts in the book which I'd love to address in a follow-up interview, which we'll do soon. And thanks for taking the time here.
Okay, well, you're very welcome. I've got 44 charts in the book, and that was the whole point that I was trying to make. Let's not overload people with text. Let's give them charts and let them see for themselves how it works. And yes, I'd be happy to do another interview.
Gary Christensen, thank you very much.
You're welcome.